we're going to figure this out, but what we'll go through today is I'm going to take you from the beginning of the last, there we go. I'm going to take you through a little bit of who PNC is, and then through the beginning of the financial crisis to where we are today, kind of in the economy, slight angle on the banking side of it. But I want to start out, obviously, by thanking Dean. Thank you, Reed. Thank you for having us here today. We're thrilled to be here. We've had a couple good meetings already. Can you guys hear me okay? Yeah. We had a couple good meetings already. It's a fascinating time in the economy. It's a fascinating time for you guys to be entering into the workforce. I don't think we talk constantly. Almost everything we go through in our business every day is we think strategically. Everything right now is unprecedented, whether it be the interest rate environment, levels of regulation, cash on our clients' balance sheets, profit margins of our clients, the lack of activity, the fiscal deficits in Europe and here. So everything's unprecedented. We have no game plan. There's no playbook that the last time we did this, you do that. So it is a fun time to be out there in the world, and I'll show you some of these stats today. It's quite entertaining. I'm going to go really fast because there's just a general story, and I'll show you a lot of pictures. We won't spend all the time on it, and then we'll come back on Q&A and hear what you guys are thinking about. But again, thank you for the opportunity. It's an important market, important relationship for PNC, and I would love to go through the Q&A with you guys, see what you guys are thinking about. So first on PNC, headquarters are in Pittsburgh. We have operations down to Florida and through the Midwest in terms of traditional branches and branch banking, 3,000 branches. Number 7 bank in the United States now, $300 billion in assets. We have national businesses in corporate and investment banking, which is business I run, earned about $2.5 billion last year. We'd be the 83rd. Our segment would be the 83rd largest S&P 500 company, and we basically do 5 or 6 things. We operate where we have branches. We operate traditional middle market, commercial, and low end of large corporate banking. So whether it be Nashville, whether it be Louisville, Baltimore, Pittsburgh, Philadelphia, the core markets of the bank. We just bought Royal Bank of Canada's U.S. franchise, so we stretched down into the southern parts of the country now. 4 big new markets for us: Charlotte, Raleigh, Alabama, and Atlanta. And then we were in Florida through the National City acquisition, which we did during the crisis. On a national scale, we have an asset-based lending business. We advance against assets. It's a very good business for us. We own Harris Williams, which is a little investment bank in Richmond, a couple $100 million in revenues, very good sell-side shop. If you know anyone in private equity or been in private equity, while most of what they do for private equity, everyone denies ever having been associated with Harris Williams because they're known for getting very, very high prices from buyers. So everyone it says, oh, we never bought anything from Harris Williams, even though they do 100 deals a year. So it's an interesting shop. We have a large treasury management business, cash management. We have a large 4th largest leasing business in the country, 3rd or 4th largest commercial real estate lender in the country, and we did very well through the cycle. We'll talk about that in a minute. And then missing one other. Oh, we have a capital markets business. We don't sell equity, and we don't sell debt. So, and we're very proud of that. And you'll see that's managed well through the crisis. So we do everything that a J.P. Morgan does, except with 3 big exceptions. We're not international, other than we move money internationally on the money market side, and we have some UK lending operations. But we are not going into other countries and setting up shop and starting to lend money in those markets. And we don't sell debt, and we don't sell equity. So that's PNC. This is exactly in the corporate bank. I thought we'd describe what we do, particularly like the upper right hand. So it's a little loan officer humor. This is the we joke about ourselves, and I'll show you in a second. We performed. I think it's so during the financial crisis. If you measure it, bear went in March of 2008. If you take the end of 2007. Take it through the end of 2011, beginning of 2012, generally what we describe as the financial crisis. PNC was, you take I think it's the 30 largest banks in the country, including Goldman, Morgan, all that. Number 1 performer in stock price, number 1 performer in EPS growth, and number 1 performer in tangible book value growth. So we were very proud of the performance through the crisis. That has a lot to do with not selling debt and not selling equity and not doing anything that we generally say we don't do anything that our customers don't want. In my experience at B of A, which was 2 years of cleaning up the balance sheet, B of A put anything on the balance sheet that made money. And if you just simply create that distinction, that's a lot of what happened to the big banks. Separate the distinction of putting on your balance sheet what your customers want you to do, and put on your balance sheet is anything that's interesting and makes money. Right? So you get to B of A and they own $4 billion in public stock of HCA. It doesn't help any client, it doesn't do anything for anyone, and they got marked obviously in tough shape on it during the crisis. They own $900 million of Nuveen, which was a muni bond asset management firm. Obviously went through a tough time during the crisis. Whole bunch of assets, China, $25 billion of China Construction Bank. Interesting investment, made a lot of money on it. Terrible use of capital when you couldn't fund your own middle market customers during the crisis and you had an illiquid stake in a Chinese bank. So big separation what we did, and then I'll show you kind of lessons learned as we go through the crisis. The two things everyone we go through this concept of you don't know, the biggest issue in trying to manage through a difficult time is recognize what your problem is. If we start out with two very basic concepts. We're in the business of taking risk, right? We can create no losses next year, but we'll be out of the business next year because we won't make any loans. And then our business cycles. If you just remember those in general about financial services, not just PNC, about anyone as you go through these slides, if just remember those two things, and then we'll come back to lessons learned after you see kind of what happened. So, and this is just the last point on PNC, and you'll see why this is important. So the first 144 years of our existence, we had $6 billion of net worth, and then during the financial crisis created $18 billion in net worth. And again, this is this concept of cycling and being positioned to take advantage of cycles, what we do in financial services every day. So now I'll go quickly for the financial crisis. So the cause, our belief is in one of the primary drivers of what the financial crisis started was negative real interest rates. We'll come back at the end of this and assess where we are today, but we're in very much a negative real interest rate position again. The single biggest, longest run of negative real interest rates in the world was Greece. And the concept is very simple, right? If your return is less than inflation, keeping money in your pocket, worth less tomorrow than it is today, so generally people go and spend it, they search for yield, and asset bubbles formed. Relatively simple concept, and that's all you really can trace the financial crisis to. When people chase assets, what happens to asset values? They soar. This is Las Vegas home prices, here's commodities, it's emerging market stocks, and here's US domestic equities and financial services. So the companies that were chasing asset values and putting asset values on their balance sheet in a levered manner, even those assets start to soar in value. So Lehman stock price up 1,700% during the pre-crisis period. You can see us down there on the track. Obviously, the levered financials did better than everything else. Here's revenue growth. If you think about what you're supposed to do in financial services, conceptually, we're tied to the underlying economy, right? So if the underlying economy is growing 2 to 3%, we steal some share, we come up with a new product or anything. The concept of 5-year compound annual revenue growth of 27% in financial services should be a red light to somebody, and that's what was happening. We have the guy who's going to be our next CEO used to run credit at JP Morgan. His mandate was to create $1 billion in revenue each year from sources and businesses that didn't exist the year before. And this is how you get to CDOs and the like. There are no client businesses that JP Morgan can do that create $1 billion in revenues that they didn't have the year before. You have to create stuff in this to create this chase for assets. So how do we get there? So if you have this type of revenue growth, I'll show you how you get 27% compound annual revenue growth from an economy growing. Here's the economy, GDP, year over year, real GDP leading through the pre-crisis era. So this was not the Chinese economy in the last 5 years. This was the United States economy pre-crisis. We're doing 1 to 2% and jumping up and down. This is how you drive growth. Look at Merrill. Merrill went from 25 times levered, right? So 25 cents on every dollar to 76 times levered. So a 1.5% move in the asset prices of Merrill. And remember, they're in some relatively risky asset classes and the firm's out of business. So you can get revenue growth by the underlying economy, by stealing share and some other things. You can especially get it from levering up. And then you get it from levering up in risky assets. From people in the accounting backgrounds, these are level 3 assets as a percentage of your tangible net worth at the height of the economy. So a level 3 asset in accounting terms is you can't actually measure the value of the asset. So Merrill had 7 times its net worth in assets that they couldn't tell you what the actual value of it was. Relatively stunning. Even us, we were over 1 times our net worth in assets we couldn't tell you the value of. Think about a mortgage servicing right, a CDO, anything like that. So if you want to grow 27% and your economy is growing 3%, you lever. You lever with risky assets. When you get bored with those risky assets, you lever with even more risky assets. It's $35 billion to $795 billion in subprime. And when you have trouble at $600 billion and growing any more, you just stop underwriting, right? So 61% of the loans were made with no documents. So here we go. 27%. Let's get a little bit of help, 2% a year, so we get 25% left. Let's triple our leverage. Let's go into the riskiest assets with the highest yields that we can find. Let's keep doing it. And when anyone challenges us, let's just create some other form of underwriting where we have no documents for everything. And when all that ran out, which is really where the crisis started to spin, is we mismatched funding, right? So if you want to buy a 10-year asset and you want to fund it over 10 years, as most people know, in a rising rate environment, 10-year funding is more expensive than overnight funding. So if your asset is only yielding you 5% and your funding for 10 years is 4%, you get a 1% spread, but you'd really like a 4.5% spread, then fund your 10-year asset in the overnight market. And this is the short-term funding as a percentage of assets in the U.S. banking system went from 30% to 70%. So we just when you're out of leverage, when you're out of risky assets to invest in, just mismatch funding. Anyone can do it anywhere, and it's a brilliant move to pop earnings for about an hour. And that's exactly what happened. So people were funding long duration assets on CP desks overnight. So the day after Bear went, and especially the Monday after Lehman went, when the CP desk shut down, when the repo desk shut down, and you have a 10-year asset, right, funded overnight, and the next morning there's no funding, you are a seller of the asset. So funding caused the financial crisis. Subprime did not cause the financial crisis. The mismatch, the amount of subprime and the leverage you had in your balance sheet, and the mismatch of funding caused the financial crisis. There was no credit crisis. We weren't over-levered. Borrowers weren't over-levered. It wasn't no document loans. Those are all a component of it. What kicked it off was the fact that you couldn't fund. You wake up the next morning, and everyone in the world, everyone on Wall Street knows that you own $1 billion of subprime securities that you bought 6 weeks earlier. There's no secret about it, and now you're a seller of it, and you can bet there are no bids at par. So you can't fund it, so you show up and sell it. When you can't sell it, you get, when everyone knows you're a seller and you have to sell and you can't fund it another day, you take any price available to you, and then you have a capital issue. And this is the spiral that got going. We used the example of Knight in a meeting earlier today. Knight Capital got in trouble this year. A technology glitch at Knight caused them to buy a bunch of $35 billion of securities that morning that they didn't want. These securities were the most liquid securities in the world. They included Apple in there, included some Microsoft. Very easy securities to sell if you can fund them for a couple days. Knight had no funding. It was running a balance sheet and it was a trading shop, had very little funding. So it went over to its good friends at Goldman Sachs and said, we're having a little bit of trouble funding this. And Goldman said, I will absolutely fund that for you. Let's start at 80 cents on the dollar, and we'll see how we do. And Goldman makes a fortune. They sell the securities over the next couple of days. They have a capital problem because they had to take 80% of book value on a $35 billion thing, and they got $1 billion of capital. Next thing you know, you're out in the market raising convertible preferred and diluting all your existing shareholders. Funding was the key to all this. Asset concentrations were the other issue. Your funding, mismatched funding on real estate, very long duration asset, and you understand the negative convexity behind it. So what happened? This is the Bloomberg Financing Conditions Index. It was a great lead indicator of stuff. I'm just kidding. It's the classic lagging indicator. This tells you when the funding markets are closed, so if you're watching this, you know you're in trouble. What happened was, you didn't have a chance, and you can see that this is March of 08, you didn't have a chance when Bear went to find an alternative funding source for your 10-year asset. The financing markets closed, and they closed immediately. And this is a measure of availability of funding. You can see it runs around 1 normally, and you went to -6, -7. So everything was on the market for sale. Everything correlated. The basic risk management concept was I'll buy some subprime in California, and I'll buy some subprime in Florida, and we should be fine. Everything correlated when the crisis went wrong is a basic flaw in everybody's risk management model. Every asset, the only asset that's yet to fall is the U.S. government debt, and we talked about that. Every other asset class fell. And so here's Las Vegas home prices. Same time for the banking sector, which was a disaster for the banking sector. So now you're out of asset growth, you mismatch your funding, you have a funding issue, and credit went on you. So at the same time that you had all this stuff, you have a drain through credit charges, so your P&L went. And you had 2 options in the banking sector. You go to the street and dilute yourself. Citigroup went from 5 billion shares outstanding to 20 billion shares outstanding. That's effectively a zeroing of their existing holders. And you can see the dilution that other people took, or you failed. You had 2 options. If you were able to raise the capital, when I was at Maverick, everyone showed up in 08 and said, you know, we'd love to sell you $1 billion of capital, and you just kind of sat at the other side of the table and just bid them down, bid them down, bid them down. It was the ultimate buyer's environment, and that results in dilution, and if you can't raise the capital, you fail and get taken over by the government. So lessons learned, we live in a cyclical industry. These are the last 3. If I asked you to draw the last 3 credit cycles in the United States, my guess is everyone would draw a spike for the last credit cycle. The last credit cycle looks just like every other credit cycle. If you'll notice, when we show this to our management team all the time, if you look at the time between cycles, it's almost exactly the same. They trough and peak at exactly the same losses every time. We do this over and over again. This is our business. So if we just recognize this, which no one else in our industry seems to want to recognize, the industry makes the same damn mistake over and over again. We are at the bottom losses. What's happening in our business today? Commercial losses at the all-time bottom. Everyone's making commercial loans. It's a business everyone wants to get into because it seems to be free. We are 100% sure losses are going up, and it's going to look just like that, and you'll go back up to 14%. It's the same thing over and over again. So the last cycle wasn't any different than the other cycle. The severity of how it came on was very different, but it was not a credit cycle. We had asset bubbles that burst. We weren't prepared on the funding side. We weren't prepared on the capital side. The actual losses inherent in the assets weren't any worse than any other cycle. This is an amazing chart for the banking industry. If you look at every time, the blue line simply measures the earnings growth of banks less GDP. So if it's positive, banks are growing faster than GDP. So every time that banks outgrow the underlying economy on a lagged basis with a very high R-squared, losses spike. And all we continue to do is try to outgrow the underlying economy. Listen to any bank out there we want to grow. Our goal for EPS is 15% a year, and it happens again and again. Every time you try, losses spike. So you go back to the cyclical point. And the big issue when you miss this cycle in our business, right? My brother works at Urban Outfitters. They miss a fashion cycle. You don't hear about Urban Outfitters for a couple quarters, and then they come out with a new cool pair of jeans, and they're back on the top. When we miss a cycle, you go out of business. And the ultimate was the #1 bank that we competed against. The #1 bank in America, the most innovative bank, when I was at Maverick, to try to get a meeting with Ken Thompson, who was running Wachovia, it was the hardest meeting to get for an investor out there. And if he came, it was 15 minutes, it was choppy, don't have time, you guys don't understand, you know, we're doing everything the new way, fast. Their big thing was velocity of balance sheet. Sure, we're putting a lot of risky assets on, but where our balance sheet churns really fast, and throws off a lot of fees along the way, and you guys just need to appreciate that until the overnight funding stops and nothing churns anymore, and then you choke on it. But you couldn't get a meeting with Ken Thompson. Jim Rohr, our boss, would come into our offices, stay for lunch, walk the halls, look at the art, you know, use the bathroom, you know, can I use a spare office? No one wanted a meeting with him. And I was just to say in the earlier group, we were considered, if you asked anyone about PNC in 05 to 07, it was a big, dumb Rust Belt bank that was missing the modernization of the economy. All that we saw was that. It just looked like any other cycle, and everything was going to blow up. So 05 to 07, you shut down, and Wachovia obviously went for it in spades. Now we have investors. We had 3 groups, 70 investors in yesterday. No one wants to ask about our bank. No one wants to ask about the equity or our loan growth strategy or any strategic things we're doing. All they want to do is ask our CEO, who is considered the big dumb Rust Belt bank that didn't understand the world, they want to ask him what his view on the economy is, because they all view that he called the last economic cycle. He said, I didn't call the last economic cycle, I just look at this chart and, you know, I'll tell you, in 8 months from now, all the banks are going to blow up again. And I don't know anything about personal income or, you know, real growth rates or anything. It's a relatively simple industry. So we cycle and we take risk. If you recognize those facts that we talked about at the start, you have to think about running the bank the best way. This is our risk appetite box that we show our people over and over again. And one of the great management lessons I've learned at PNC is that you can get on a phone call with everyone on there and tell everyone it's a very, very important phone call, and we're going to tell you a very, very important strategy the bank has, and you tell it to them, and then you go back to your office and you assume everyone's out doing it. You have to tell it to, we have 5,000 people in corporate institutional banking. You have to tell it to them 50 times, and then you have to show them what you mean 100 times. And this is, you think everyone just listens and goes and does it, but you have to continue to explain and make them understand it. This is the size of our credit appetite box. It doesn't change. We hear it right now in the markets. The classic thing that's going on is because interest rates are so low, this is what we hear all the time, so we're running acquisition models and we're getting no value any of these regional banks, and we have an 18% cost of equity capital hurdle return. And everyone says, well, you know, you got to change that to 5, you know, because their interest rates are so low, you know, and things feel so good. Shouldn't you lower your hurdle rate returns? We never change. We don't change this, and we don't change our hurdle rate returns. You guys all tell me that, you know, our beta times the equity risk premium, you know, plus the 10-year rate is this, and you really can lower your hurdle return. Our view is totally different, is that if you're capturing that risk premium correctly, you're capturing multiple cycles in there. In our world, how our financial services world gets in trouble, when rates feel low or real interest rates are negative, everything feels good. So when your models don't work, you change your criteria. In 2008 to 2010, when everybody else was out of the market, either raising capital, trying to survive, and the world felt horrible, and you left the current rate of return that we have in the models, everything worked. Every single loan we looked at, every single deal we looked at, every product we sold, everything worked on the risk return thing, and we took in as much as you possibly can. It felt awful. Right now, you take as much in as you possibly can, it feels amazing. It's the greatest environment we've ever been in. There's no losses, there's no nothing. I'm getting 7% return on this. Interest rates are 180, this is a home run. It's the exact wrong time to go out and chase stuff. 2008 to 2010, no competition, tenors short, spreads wide, and you're the only guy in town. Everything feels good, even though all the returns look good, even though everything felt bad and you have to chunk through it. But that's how, again, this managing through the cycle concept. It's cyclical investing. It's all the stuff we do. This is, we thought this was kind of interesting. This is when we talk about a Six Sigma event supposed to happen every 2 million years. And most models, if you look in the financial services sector, and we're going through all of our stress testing with the Fed now, and they've now taken it you know, to the 1 in 1,000 event. So if we go to the 1 in 2 million year event, Six Sigma event, so any model leading into the crisis basically said, there's no way this isn't the 2 millionth year. You know, it's only one of these every 2 million years. If we model that, we'll do no business. You heard this all the time. If I model the 1 in 1,000 event, I'm going to lose out on every opportunity in the market. So here's the number of Six Sigma events that happened between 04, the blue line, the 0000 is 04 to 08, and then you go post-bear to current. So there's been 22 Six Sigma events in the S&P 500. Everyone modeled the 04 to 08 period. Our concept on this risk management is a culture, not a model. You got to have your models. We got to run all the stuff. But unless you understand our CEO's basic theory of, I'm just looking at the chart, looks like things aren't going to get so good. That is, you've got to get that culture, and you got to teach your people that risk appetite box can't change because these things do happen. Biggest thing that we try to understand, and one of the big mistakes the financial services sector learned, is that everyone set P&L goals. Again, I talked to Lehman Brothers on the front cover of the annual report in 2006. We target 15% annual EPS growth. So if we told our people today to go get 15% EPS growth next year, they'd all look at us cross-eyed. And the only way they can get 15% growth is they're going to say, 1, can I lever more? 2, can I mismatch my funding? Or 3, can I take more risk? So as soon as you set your P&L and let that drive your balance sheet, then you've made the first mistake. We basically say we have a balance sheet. We operate in these markets. Our balance sheet is capable of supporting X amount of growth. The underlying market is X percent of growth. If we can do that and run expenses at 300 or 400, you can grow 5, 6, 7%, which is what we've done, and run expenses up 100 or 200. If people have done the operating leverage math, 1 plus 1 is greater than 2. So grow revenues 4 and expenses 1. You compound earnings at 7. You pay a 3% dividend, and you compound 10% through an environment. You know how many companies in the S&P compounded 10% through the last 10 years? It's 4. It was a pretty remarkable type concept. All you have to do is compound 10. We can't grow 30. We can't do Facebook. We can't do any of that. But if you can compound 10 over a cycle, you'll be one of the top 4 or 5 companies in the market. So where are we today? Pretty simple issue. Public sector's broke. Private sector's never been richer. Cash on the left, profit margins in the middle, net debt to equity. Never been less leverage on corporate balance sheets. Never been more cash, and profit margins have never been higher. We're operating in an environment where the governments are poor. Every client we tell you says, I'm pretty sure some of this is going over here. Whether it be through taxes, through healthcare, there's going to be a redistribution of wealth from the private sector to the public sector. And what does that draw? And then here's corporate profit margins. And so you take private sector, banks, balance sheets in great health. Private sector's doing nothing. They're doing nothing because they're worried about that redistribution and how that takes place. Worried about, they worried about the fiscal cliff. They're still worried about it. They worry about Europe. They worry about slowdown in Asia, if there is one. But even 10 to 7 scares some people. Europe, very challenged situation, obviously, from a debt perspective. We thought this was, we continue to show this. This is, we can't solve Europe's problems. This is one to try to figure out why they're having some issues. But we think the real issue in Europe is this chart, which is 3-dimensional. We don't have glasses. But if you follow along, the horizontal axis is leverage. So is capital ratio. So the more levered you are, the lower the number is. So far to the left is levered. On the vertical axis is liquidity. So assets to deposits is a good source of liquidity. So higher that is, the worst case you are. And then the size of the bubble is how important you are to your home country. So if you look at the European banks, they're levered, they have terrible liquidity, and they're incredibly important to the countries. If you look at the red dot in the middle, we're completely irrelevant to the United States. We have a lot of capital. They can live without us and not with us. We have a lot of capital, and we're in a very good liquidity position. This is a very difficult situation for Europe because if you force your banks, if you do what we did, and we talked earlier about this, we gave Europe the roadmap. TARP, while politically you can disagree with it, it was the absolute right thing for the government to do. It had to shore up the banking sector before it could think about any other part of the economy recovering. Europe had that opportunity and didn't do it. There was some social reasons around that, and then the other bigger reasons is you really can't slow the banks in Switzerland. It's such a huge part of the economy that they haven't forced these guys to recapitalize, shut down. There's been very few bank failures in Europe, a lot of government support for the banks. So when you go back to this in the United States and why things are so good for the private sector in the United States, is the fact that the banking sector recapitalizes is in very healthy shape, albeit with help from the government. So Europe, very difficult situation. In the U.S., GDP, the last 2 data points are a little bit funny because you had an inventory build in the 3rd quarter, and then yesterday you saw 0% GDP growth, but you basically even them out, and it's been 1.5% if you normalize. So decent GDP. We're bumping along 2%. We think it's going to be a little under 2 in the first half of this year, a little over 2 in the second half of next year. Jobless claims are grinding in, very good. Housing's been huge. It's bounced off the bottoms, very strong. And consumer spending, I didn't put it in here, it's been very strong. Again, supported by that resumed confidence in the housing market. Where could we be headed? So this is our forecast for the rest of the year in GDP. Slow start to the year. You still got a little bit of Sandy drag. You got the fiscal cliff drag for about 75, 80 basis points, 20 basis points of Sandy, so it's kind of normalized too. And then you come into the back half and it's not a bad economy. Our clients are doing fine. They're in great shape. You saw earlier productivity margins feel good. Credit's great. So it's not a terrible economy at all. Again, they're just not doing a whole lot in terms of strategically plant building M&A, syndications, because there's still a fair amount of uncertainty out there. Is our belief on even though that housing is, if technically someone will tell you housing is 2% of the GDP or something, we think it's obviously the follow-on effect is much more significant. The back half growth of this year is really driven by this bounce back in housing. The strength of the housing bounce back and the follow-through effect that it has and the confidence in consumers and the curing of negative equity is a huge move for economy and a big supporter of it. Thought this was interesting. Very strong correlation between, this is a reverse chart of initial claims relative to the S&P 500. Biggest fit chart we can find on stocks is initial jobless claims. Really can't correlate anything else. So as this job market continues to grind in, equities are supported by help from the government, which gets us to, this is we're going on a 35-year bull market for bonds. Obviously, this is completely artificial in the last part of this. And if this is the government's, this is an inverse chart of the government stock price, and it's buying back the most amount of stock at its all-time high price at the end of a 35-year run. This is unprecedented. It's obviously manipulative. This is what is supposed to be the most liquid market in the world, and there's no natural price discovery going on. We joked earlier, if we bolted the doors and I held an auction for 10 years at 180 and any one of you bought it, we're going to have to send you away from Owen. The natural bid for 10 years obviously isn't 180, but the government's supporting the market, and you got a bunch of people trading and playing around that. This is what I was talking about earlier. There is no playbook for this. So since they started trading the 10-year, that's traded for 2,642 weeks, and the less than 2% is 43 weeks, and it's all going on right now. So we've only been here once in the history of the 10-year. So again, there's no playbook. We don't follow what we did last time. There's nothing to fall back on. So this concerns us, obviously. And then I'll finish with this chart. We're back in negative. You can see the dip around 08 in negative real rates and working the whole way down. We're back in a more negative interest rate position. You are seeing asset bubbles form, and we're back in we're back into the cycle of where we were before. We have much stricter regulation now, so the banks have a harder time of getting into trouble than they did before, but it is very clear that there are risks out there. So I'll stop there and take questions from you guys in terms of anything you want to talk about.
Can you talk about the differences in the places that you've worked in terms of working in investment banking and asset management and then in a bank and helping run a bank?
So I'm still trying to find my calling. So I've worked on the sell side, then the buy side, and now on the client side. I think each has been important, and I would encourage all of you to. PNC is a place where people come to PNC, they love it so much, nobody ever leaves. And I think I encourage people to, even though they would leave PNC, encourage people to take opportunities and get different experiences in life, because there's always a learning experience to it. But Morgan Stanley was frustrating in the fact that you're always, the client says, I've decided to do a deal, and then you go help them find a deal, but ultimately you have no control, and they generally always think you're trying to sell a bag of goods to them, right? You're always motivated in one way because you're getting paid a fee in a certain way. But it was a fun environment, learned a lot. Technical training, I encourage anyone through formal training programs. It's the best thing you can do. They spend a whole bunch of money on you, and you go through it, and there's no obligation at the end of it. It was a great program to go through, and just strong fundamental training. And the best thing Morgan Stanley ever taught me, and I try to teach our people it, but it's amazing, even in PNC, is there was a zero tolerance for any type of error. I mean, it was just the pressure on not making a mistake of any type, whether it be formatting, spelling. I mean, it was a life-changing event if you sent a book out with a mistake in it and the managing director called back. I mean, you would hunkered under your desk and went into depression. That type of zero tolerance, even for minor mistakes. I get stuff every day that's just like, I don't follow this. They're like, oh yeah, it's wrong. I'll send you a new one. We should we try to hold ourselves. And when Christian nice enough to invite me to talk to the young analysts, tell them zero tolerance. Morgan Stanley it was so strict, and it was great, and it was a great life experience that even when I get I find myself walking down the street now, and you're like, God, I can't believe that stores use an 8-point, Times New Roman font on that. Shouldn't it be, you got to build that up. You start, really, it's not great a personnel, I think. And Maverick, so the decision to go to Maverick, what I was thrilled about with Maverick was, and you'll laugh because they're now back on the side of it, was that it was a pure, I controlled my own destiny, right? Pay was very simple. You either made money on your investments or you didn't make money on investments. It didn't, we joked earlier, you didn't need a 360 evaluation at Maverick. A great attitude and good work ethic and long hours worked didn't matter. Nobody cared. Either your investments worked or didn't work. You didn't have to come to work. You could be anywhere you wanted in the world as long as you were theoretically investing, making money. Some people said, I'm just a better thinker and buy a pool in Florida. And they go sit by a pool in Florida, and either their stuff worked or it didn't work, as long as there was math behind it. And it was a pure return world, and it was incredible. There was no other things. You controlled your own destiny. You controlled your own destiny. The most frustrating part of Maverick was, and we took large positions in public equities, so you'd buy $500 million of waste management, and your whole theory was based on the fact that waste management could take margins from X to X, and they could enter this whole new business line and do this, and you put your money in and you're done, right? Then it's left up to management to go do it. And you can go tell them, they'll meet with you 100 times and say, that's great, I really think that would be a great move for us, thanks. And you go away and they never do it. And so you had a lot of money. I thought that would cure the issue in investment banking where you had no control. I was in full control, but you actually had less control because you had real capital at stake, right? The issue in investment banking was you don't have anything really at stake, right? It's all upside. You get the deal, but if the deal doesn't go well, you got no capital at risk. And thought the theory in investing money was you always had something at stake, but you literally had no control then, and you had capital at stake, so it was very painful. And then in this business, it's terrific. We would live and die by our own mistakes. It's our own capital. It's our decisions. We get all the help in the world. Every investment bank in the world calls on us. Every consultant in the world calls on us. We get every piece of input. You can have meetings all day with people independently at no cost thinking about your business for the right that you may hire them to do something. So you get all this input in the world. You get great people to work for you. You make every decision, and if it's the wrong decision, it's your fault. And if it's the right decision, you manage through. And I found that to be the most interesting part of the job versus any of the intermediary steps in the capital, kind of in the capital flow. I said earlier, and I said at lunch, and I think it's an important point, is that the greatest thing about investing money, I would encourage everyone to invest money, is you learn to make a mistake. Right, all of us, I hear all the stories. I just gave someone a meets recommendations, and they said, God, this is the first time I've gotten a meets recommendation in 35 years. Right, so that person is trained to never, ever make a mistake. They've been held to a exceeds expectations standard their entire lives. They probably got all A's in their high school and grades. And everyone comes into Maverick having never made a mistake in their lives. They pass all these tests to get in there. You pass all these brain teasers, and you get in there, and you're wrong most of the time. And you've got to get a couple right, and that is a great discipline to learn. You've got to make decisions. You've got to know when to cut your losses. The single biggest mistake made in investing is thesis creep, right? So I invest in Owen because Owen's going to take advantage of great demographics in the South, and then demographics in the South don't move, and you say, yeah, but Owen's cheap now. It's the stock's traded off. I was wrong in that theory, but now it's 4 times earnings, and I'm in it because it's cheap. And then it stays cheap, and it's cheap, and it's cheap, and you say, I'm still, and I can't sell it now. Now it's so cheap. So you just thesis creep through it. We watch it every single day in our business, thesis creep. Right? We made this debit card that's going to give you free gifts at the circus. Well, no one's taking the debit card. Well, now we got them all made. We should just stay with it. No, we shouldn't. We should cut it, take our losses, and move on. And that's a great discipline to learn. And people don't appreciate it at all. You have to be right in corporate America 100% of the time. And I guarantee you that's not the attitude at Facebook, where the turnover of ideas and the pursuit of ideas is probably 50 times the velocity of what it is at a PNC or a GE or something.
We've got a class in here in a few minutes, so I want to do one more question. And I also, as I began, as I said, we could spend the whole afternoon with you. And I want to thank you on behalf of this
it's fun.
university for being here. You're absolutely welcome back, and we'd love to have you anytime if we can.
Well, we're telling a story here, and it's going to keep going, so we'll have to follow up on it.
One more question.
We don't know the end of it.
What advice to us? Just one.
Advice?
Yes.
I think it's be wrong. Take chances and be wrong. But it is. It's don't go. If you go, I would say that's probably stage 2. Stage 1 is work hard. Well, we tell the analysts this all the time: work hard, add value. Don't be too early on. Don't be too curious. And the great, I don't know, the lesson I was learned, if Lou says I need the top 50 MSAs in the country, just give me a list of top 50 MSAs in the country. Give them something else. Follow up on it. If something changes, continue. Kind of stake your claim in the ground everywhere. Don't just do it and hand it in. But then don't act too curious. Don't say, hey, Lou, that's really interesting. What are you thinking about it? You want to do why are you thinking about the top 50? So, and we watch that develop as you go through. The early on, get after it, add value. Don't just do it. Add value and stay on it. But don't be too curious if you can get where I'm going. And you start to gain a reputation as a person who gets things done, and you don't always get them done. You're not always going to be right, but you got to take those chances. But the only trick I've ever done is found people that care and want to be better in their careers, and you deliver them more and more every time, and they know what to do with it. And you hang on, and then when they give you a chance, you take the chance, and you be bold. And if you make some mistakes, you make some mistakes. And if it's always built on the same philosophy, you worked hard to get there, you've used good thought in forming it, and they give you credit to be wrong, and you keep moving forward. That's very different from never being wrong, which is, well, this is what you want. I gave you just what you wanted, right? And always just give them what someone wanted, and never going that extra step. It's the hard work. It's the adding value, and then the ability to take chances and be wrong. I think is if I've done anything, I'm not sure what I've done. It's those 3 things. And if we're pursuing strategies in our bank that are we've gone after it and done all the research, and if I'm wrong, I'll suffer the consequences, and that's what we should be held accountable for that in our business. Am I right? We'll keep doing the same thing we've been doing, but I don't know if that's very good, but I'm trying to sum up 20, 25 years, but you guys are obviously very successful in getting to where you've gotten to. So you all have your own tricks for doing it, but those are my views.
Please join me.
Thank you, guys.